Good afternoon, folks. Welcome to the Liberty Call for March 29th, 2022. It's a Tuesday. I hope everybody's having a great day out there. It's a little gross here in Colorado. It's overcast and a little chilly. Certainly not like the 60 or 70-degree day we had yesterday. But I hope everyone else out there is having a great time. I apologize for being a little late. It's almost 3 o'clock. I had to go run an errand into town and get back as quickly as I could so I could dispense the news and provide the excitement that is the stock market and the economy to all the good people out there. So again, hope you're having a great day. And sorry if I pick at my eye. As I was leaving the neighborhood to head into town on my 20-mile trek into civilization, I don't know if a hair blew into my eye or what, but it always feels like sand, and that is like the worst feeling. So driving with your eyes shut like this, squinting, is pretty unpleasant. But by the time I got to where I was at, evidently whatever's in my eye had flown out. But now it's just a little tender at the moment. So if you see me squinting, that's why. If you're listening on audio, you won't know the difference. So, all right, let's take a look and see how the markets did today. The Dow Jones was up almost 1% at 0.97, closing at 35,294. The S&P 500 closed at up 1.23% at 4631. NASDAQ was up 1.84%, closing at 14,619. Small caps are up over 2.5%. The VIX was down 3.72% today, down to 18.9. So for those who are VIX watchers out there, kind of I know I've said this probably a dozen times already, but anything under 20 I view as normal. 20 to 30 in the VIX is your yellow light, proceed with caution. And anything above 30 in the VIX is typically that we're in some major volatility, and buckle up, buttercup, because we're going for a ride. So it does appear that the volatility is waning a little bit right now, but again, looking at the big picture on where the last 3 or 4 years, recession is probably in the cards at this point, especially with interest rates going up. The economy has to slow down to bring down the inflation. So, it's kind of a damned if you do, damned if you don't type situation right now. All right, let's look at the other exchanges in the Americas. Canada was up 0.5%, Brazil up 1%, Mexico was up 0.77%, Eastern Europe looked really good. Germany was up almost 3%. France was up over 3%. The Euro Stoxx was up nearly 3%. And again, lots of 1s, 2s, and 3s. I'm seeing all the way down. The first red I see is one of the Russian exchanges. It was down 0.91. The other Russian exchange was up 7.11%. Again, more green through the Western Asia. Looks like the only red markets in Asia, looks like the Chinese markets were down. Shanghai, the SCSE component, the China A50, and the DJ Shanghai were all in the red, all less than 0.5%. The Hang Seng was up almost 1%. And, the smaller Asian markets, mostly green. So for trading day, March 29th, things look pretty good. If I didn't know all the back history of everything that's going on in the world, I probably would feel pretty good about where things are at right now. But, again, we do have the ability to use hindsight and see what's been going on the last, I'd say really 3 years. I mean, 2019, the economy was cooling down, and it looked like things were going to head into a bear market recession at the time. And then this mystery cold came out of nowhere and gave a perfect excuse for the government and the Fed to pour all this money into the economy. And, now we're having to deal with the ramifications from that. So we'll see what happens. So like I said, I don't have high expectations for what's for the next, I'd say year probably. So, but there's going to be opportunities there. I don't want to get everyone down. There are definitely real opportunities that are going to be presented to us. So you just got to keep your eyes open. And when there's blood in the streets, that's usually the best time to put your idle cash to work. So, all right. I got 3 articles I'm going to blaze through today. First one's just a market recap. S&P 500 rides tech rally to top 4,600 amid progress of Ukraine-Russia talks. Written by Yassine Ibrahim from Investing. All right, let's dive in. The S&P 500 notched gains on Tuesday as a tech-fueled rally and growing hopes of a de-escalation in the Ukraine-Russia conflict helps stocks shrug off further signs from the bond market, sounding the alarm of a potential recession. Russia sees its pledge to reduce military activity in the Kiev and Chernihiv areas as a means of building up trust in talks with Ukraine that could ultimately lead to an agreement that could prove key to ending the war. There are doubts about whether much can be read into Moscow's willingness to scale back military activity as Russia's progress toward Kiev has stalled recently, and there wasn't any mention of cutting back military operations in the south of Ukraine, where fighting has intensified. The prospect of progress at the talks were boosted a day earlier after Ukrainian President Volodymyr Zelensky said he was open to discussing some of the Kremlin's demands around neutrality. Oil prices dominated by headlines from Ukraine and Russia were in the red, dragging energy stocks lower as investors cooled their expectations of a prolonged war, disrupting energy supplies. The growth corners of the market included tech and consumer discretionary continued to add to recent gains. Chip stocks resumed their upward trend following a sluggish start to the week as NVIDIA climbed following favorable commentary on the stock from Wall Street. Tigress Financial raised its target price on NVIDIA to $410 a share from $400, citing new product launches and growing data center demand. Elsewhere in tech, Uber Technologies rallied 7% as the ride-hailing company is reporting closing in on a deal with San Francisco taxi company to include taxis from the city on its platform. I don't know if I'd really want to ride in a taxi if I ordered an Uber, but part of the allure of an Uber is you don't have to ride the dirty taxi with some person who doesn't speak English. But hey, anyways, real estate also led the broader market higher, underpinned by CBRE, Extra Space Storage, and Equinix. In other news, Nielsen Holdings surged 20% on reports that a group of private equity investors, the rating, I guess probably say they're going to buy the ratings company for $16 billion. Dude, someone needs to proofread these. I mean, are these written by robots? I mean, lots of weird, words in the wrong places. And anyways, FedEx was up more than 3% after the logistics company announced that the founder and chief executive Fred Smith will step down. Smith will be succeeded by current president and chief operating officer Raj Subramaniam. The transition is expected to be seamless, in quotes, Oppenheimer said. Quote, in recent years, Mr. Smith appeared to have been ceding an increasing amount of operational and investor-facing responsibility to his top reports, particularly Mr. Subramaniam, it added. The move higher in stocks hasn't taken focus away from the bond market, in which a key part of the Treasury yield curve briefly inverted, exacerbating concerns about a potential recession ahead. The yield on the 10-year Treasury briefly dipped below the yield of the 2-year Treasury for the first time since 2019. A yield curve inversion has preceded every recession for the past 40 years. All right. So, good news. Some things are up. But again, I personally see this as a short-lived rally. But again, I could be completely off. These morons who run things could, guide us into smooth oceans or smooth seas and, following winds, and we could have just the most pleasant experience over the next 2 to 4 years. But again, I doubt it. All right, next article. Oil hits 2-week low despite dubious progress in Ukraine talks. This is written by Bharani Krishnan from Investing. Crude prices neared a 2-week low on Tuesday despite dubious progress in Russia, Ukraine. Yeah, well, okay, we already got that. Brent crude, the global oil benchmark, settled down $2.25 or 2% at $110.23 per barrel. It fell to as low as $102.25 during the session. New York traded, or WTI, West Texas Intermediate, settled down $1.72 or 1.6% at $103.24. WTI fell below $100 support to $98.58 earlier, marking a near 2-week low. The slump followed Monday's 7% drop in both crude benchmarks and reinforced the sheer volatility that has become the new normal for oil these days. It's a phenomenon that appears encouraged by longs seeking to buy the dip in crude to profit big time later. Ukrainian presidential advisor Mikhailo Podolyak said on Tuesday, peace talks have been successful enough, in quotes, for a possible meeting between President Volodymyr Zelensky and his Russian counterpart, Vladimir Putin. Quote, we have documents prepared now which allow the presidents to meet on a bilateral basis, end quote, he told CNN. Russia's top negotiator in the Ukraine crisis, Vladimir Medinsky, meanwhile told Moscow-based TASS news agency that de-escalation around the Ukraine capital of Kiev did not mean a ceasefire was in progress. Reuters was also quoted a Western official speaking anonymously that, quote, nothing we've seen so far has proven that Russia is really serious about peace negotiations, and it seems to be more of a tactical exercise to buy time, end quote. Quote, the diplomatic language would be easy. It's too easy or too early to tell, but the reality is these guys are just jacking us around, and oil bulls are only happy with the upward swing in prices that's likely to come from each dip, end quote, said John Kilduff, partner at New York energy hedge fund, Again Capital. Quote, just look around look at the trend. Monday through Wednesday are sell-offs, and Thursday and Friday are buyback days because no one is prepared to go short into the weekend, not knowing what could happen. The only guys winning are those playing the volatility, end quote. Few market participants also expected prices to remain depressed beyond Thursday when OPEC Plus holds its monthly meeting. The 23-nation strong oil producing alliance is bent on keeping prices at or above $100 a barrel and has not budged in adding a single barrel beyond the monthly increments of 400,000 barrels a day per day in production it has allowed since last year. Quote, longer term pressures remain and OPEC Plus looks unlikely to do anything to alleviate those this week, end quote, said Craig Earlham, analyst at online trading platform Owanda. While the OPEC Plus has repeatedly said it will remain apolitical and base its decisions purely on achieving a balanced market, Earlham said the reality suggested otherwise. Quote, given how unbalanced the market is and the fact that at the center of the alliance is the country to blame for most of the recent surge in oil prices, it's hard to view a decision not to increase output targets as anything but political, end quote. Aside from the Russia-Ukraine narrative, traders were on the lookout on Tuesday for U.S. weekly oil inventory data due after market settlement from American Petroleum Institute. The API will release at approximately 4:30 p.m. Eastern Time a snapshot of closing balances on U.S. crude, gasoline, and distillates for the week ending March 25th. The numbers serve as a precursor to official inventory data on the same due from the U.S. Energy Information Administration on Wednesday. Again, the people who typed this, I wonder if they went to English class. For the week ended on March 25th, analysts tracked by investing.com expect the EIA to report crude stockpile drop of 1.56 million barrels on top of the 2.51 million decline reported for the week of March 18th. On the gasoline inventory front, the consensus is for a draw of 1.9 million barrels over the 2.95 million barrels consumed the previous week. With distillate stockpiles, the expectation is for a drop of 1.67 million barrels versus the prior week's slide of 2.1 million. So looks like inventory for oil is going down, and we're not getting any help from the Middle East. So, if we only had more oil here in America, it's crazy. I guess those, 200 or 300 or 100 or 200 rigs that are still not online yet, maybe they're broken. I don't know. It's crazy. All right. Last article here, Analysis-U.S. Treasury yield curve flashes red to investors. This is written by Megan Davies and Ira Loshbazvili. Nice name. All right. The U.S. Treasury yield curve is flashing a warning sign to Wall Street, where many are worried that a recession could be in store after bond investors pushed up short-term rates to the point where yields on the 2-year Treasury were actually higher than the 10-year Treasury. Such a phenomenon, called a yield curve inversion, in quotes, is a key metric that investors watch as bond yields impact other asset prices, feed through to bank returns and have been an indicator of how the economy will fare. Aside from signals that it may flash on the economy, the shape of the yield curve has ramifications for consumers and businesses. On Tuesday, one of the most closely watched parts of the yield curve, the 2 to 10-year yield curve, briefly inverted after weeks of sharp moves in the U.S. Treasury market, where investors have sold off Treasuries, anticipating aggressive interest rate hikes from the U.S. Federal Reserve. Gosh, people calling me in the middle of my presentation. How rude. Have sold off Treasuries, anticipating aggressive interest rate hikes from the U.S. Federal Reserve, which is fighting surging inflation. That sent a warning sign for investors that a recession could follow. Hey, I mean, seriously, folks. I mean, if it's not, there's not a neon sign like trouble ahead, warning. I mean, you have to have your head in the sand at this point. The last time it inverted was 2019, and the following year, the United States entered a recession, albeit one caused by a global pandemic. I personally think that they used the pandemic as an excuse to flood the economy with cash and avert a recession temporarily. We're getting ready to go through it. All right. Quote, a lot of people focus on this, and there could be a self-fulfilling expectation. They see the 10 to 2-year invert and believe that there will be a recession and a change behavior, said Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University, who pioneered using the yield curve as a predictive tool for recessions. Quote, so if you're a company, you cut back on CapEx and employment plans, end quote. Harvey, who focused his research on a different part of the yield curve, added that being prepared for a recession was, quote, not a bad thing. So when it occurs, you survive, end quote. Broker-dealer LPL Financial said the 2 to 10 inversion is a powerful indicator, pointing out that it predated all 6 recessions since 1978, with just one false positive. According to Anna Gagger, global investment strategist for Commonwealth Financial Network, the lag between the yield curve or between the curve inversion and the start of a recession has averaged about 22 months, but has ranged from 6 months to 36 months for the last 6 recessions. Some investors caution that the yield curve is just one indicator among many to look for when predicting recession. Indeed, equity markets have shot higher in recent weeks, with the S&P 500 cutting its year-to-date loss to around 3% after confirming it was in a correction last month. For many market participants, however, the curve has become a classically forward signal. Quote, there is definitely a psychological element to it, end quote, said Gennady Goldberg, senior rate strategist at TD Securities. Quote, the yield curve has worked in the past because it has been a signal that the end of the cycle is coming, end quote. Yields of short-term U.S. government debt have been rising quickly, reflecting expectations of a series of rate hikes at the U.S. Federal Reserve, while longer-dated government bond yields have moved at a slower pace amid concerns policy tightening may hurt the economy. As a result, the shape of the Treasury yield curve has been generally flattened, in some cases inverting. Not everyone is convinced that the yield curve that the curve is telling the whole story. Some say the Fed's bond buying program of the last 2 years has inflated the prices of 10-year Treasuries, keeping the yield artificially low. They say that the yield is bound to rise when the central bank starts shrinking its balance sheet, steepening the curve. Clouding the picture further, different parts of the yield curve have been sending different signals. While financial markets see the 2-year yield as a good proxy for the Fed policy and closely follow the 210 part of the curve, many academic papers favor the spread between the 3-month Treasury bills and the 10-year notes. This yield curve has not indicated recession yet. Eric Winograd, senior economist at AllianceBernstein, said discussion of the yield curve inversion was, quote, overheated. Quote, I understand the narrative, and I think from a risk-taking perspective, there is good evidence that a flatter inverted yield curve is a challenge for broader risk assets, but I am not going to worry more about a recession if the yield curve inverts by 5 basis points or doesn't, end quote, Winograd said. Investors may be more dismissive of an inversion this time around, as the Fed remains very early in the hiking cycle, with time to ease off the brakes if the economy appears to be slipping into a downturn. TD Goldberg said. Researchers at the Fed, meanwhile, put out a paper on March 25th that suggests the predictive power of the spread between the 2 and 10-year Treasuries is a signal of a coming recession is, quote, probably spurious, end quote, and suggested a better herald of coming economic slowdown is the spread between Treasuries with maturities of less than 2 years. Still, for some, the trend is not to be ignored. Quote, when things invert, you are definitely much closer to a recession than a good outcome. And that's exactly where we are today, end quote, said Edward Al-Husani, senior interest rate and currency analyst at Columbia Threadneedle. Quote, it's clear we have arrived at a point of stress in the markets, end quote. So, like I said, it does not look really good, unfortunately, at this point for where things are headed. And remember, our government did this. They chose to shut down the economy for a cold, and they chose to flood the economy with new paper or money, and had, they did stave off recession 2 summers ago, but at what cost? We're in much worse shape today, in my opinion, than if we had just left things alone. And, if we had, again, not created 40% of the dollars in circulation over the last 2 years, we wouldn't be seeing, costs going up all through the economy. Yeah, gas prices might go up here or there, based upon, the supply demand curve. Gas prices, or oil and gas prices may have spiked a little bit over the last, 6 weeks with the hostilities in, Ukraine, but we wouldn't have had the inflation of, fuel prices up to where we were in, say, January or February. It would have been more stable. So, anyways, again, I'm just some guy sitting out here in the mountains nobody gives a damn about. So, I'm done with everything I have for today. If anyone needs anything from me, you can reach me at dsafinancialgroup.com. All my contact information is there. If you want to send me a note or book an appointment, feel free to do so. I'll be back tomorrow with the Liberty Call for Wednesday. Hope everyone has a fantastic night, and I'll see you then. Bye-bye.